Quick experiment. Take a $100 bill, put it in a drawer, and don't touch it. 10 years later, you open that drawer. Same paper, same 100, nobody touched it. And yet it buys less than it does today. Sitting perfectly still in the dark, your money got weaker. And it's not just your drawer. Look around. Coffee, bread, a movie ticket, rent, all of it drifting upward year after year, like a tide that never goes back out. This slow leak has a name: inflation. And almost everyone explains it by saying prices go up. But that's not the cause. That's just the thing you already noticed. Today, we're going to look at what's actually causing it underneath. And by the end, you'll never look at a rising price the same way again. First, one idea that changes everything. Inflation isn't really things getting more expensive. It's your money losing value. The same event from two angles. If a coffee goes from $1 to $5, you can say the coffee got pricier, or you can say each dollar now buys less. Economists focus on the second one, because when the dollar weakens, everything gets pricier at once. And here's why a dollar can weaken. Money has no fixed value of its own. It's worth only what it can buy. So its value depends on a simple balance: how much money is in the economy versus how much real stuff there is to spend it on. When money and goods grow together, prices stay stable. When money grows faster than goods, each unit buys less, and prices rise. That's inflation. And that balance can tip for a few different reasons. Two main engines, plus a third thing that keeps them running. Engine 1. Too much money chasing too few goods. Economists call it demand pull. Picture a town that can build exactly 100 cars this year. Now everyone suddenly has extra money, and 200 buyers show up. There are still only 100 cars, so the seller doesn't lower the price, he raises it, until only the 100 highest bidders are left. Demand pulled the price up. And we lived this. In 2020, to keep economies running through the pandemic, governments and central banks poured enormous amounts of money into the system. Stimulus, cheap loans. In the US, the money supply grew about 40% in 2 years. Meanwhile, factories were shut and supply chains were broken, so the world was producing less. More money, fewer goods. And by 2022, US inflation hit about 9%, the highest in 40 years. You could see it in one item: used cars. Everyone had money to spend, but a chip shortage meant almost no new cars were being built. So buyers rushed into the used market, and used car prices jumped around 40% in a single year. Most explanations stop here, and that's where they get it wrong, because inflation can happen even when no new money is added. Engine 2. Cost push. Prices rise because making things gets more expensive. The biggest driver here is energy. Almost everything you buy is grown, built, shipped, or refrigerated using it. So when energy gets expensive, it quietly raises the cost of nearly everything. The classic case is 1973. Oil-producing countries cut supply, and oil roughly quadrupled in a matter of months. But you don't have to go back that far. In early 2026, conflict in the Middle East choked off the Strait of Hormuz, a narrow channel that carries about a fifth of the world's oil. Squeeze that and the whole world feels it. Oil spiked to around $126 a barrel, one of the sharpest jumps on record, and the price of everything that runs on energy rose with it. No new money was printed. The cost of energy alone did it. So remember, sometimes inflation comes from the money side, and sometimes from the cost side. Mix them up and you'll blame the wrong thing, and reach for the wrong fix. 2 engines down. The third piece isn't really an engine. It's what keeps the others running. Expectations. Inflation can become a self-fulfilling prophecy. If everyone believes prices will keep rising, they act in ways that make it true. Workers ask for bigger raises. Businesses raise prices in advance, just in case. Landlords push up the rent. All of that does raise prices. which confirms the belief. And it happens again. The snake eats its own tail. That's why some countries can't shake it. Argentina has struggled with high inflation for decades. People there barely trust their own currency. They reprice constantly and spend fast before the money loses value. Multiply that across millions of people, and inflation keeps itself alive long after the original cause is gone. At that point, the belief itself is the cause. Engine 1 needed a lot of new money. So where does it come from? Here's the part that surprises most people. The vast majority of money isn't printed by the government. It's created by ordinary banks every time they make a loan, as numbers on a screen. And above all those banks sits the central bank, the referee, which can make money cheaper or more expensive for the whole economy. That is the lever that controls this machine. The central bank's main dial is the interest rate. Lower it and borrowing gets cheap. People take more loans, banks create more money, spending rises, the economy heats up, and inflation climbs. Raise it and borrowing gets expensive, spending cools, and inflation eases. The classic example is the US around 1980. Inflation had been running out of control for a decade. So the new central bank chief, Paul Volcker, raised rates to nearly 20%. It caused a painful recession. It was deeply unpopular, but it worked. It broke inflation. Now, the opposite. If a government ignores that dial and just prints money to pay its bills, you get the famous disasters. Zimbabwe printed so much, it issued a $100 trillion note that couldn't buy a bus ticket. Germany in 1923 printed so fast that prices doubled in days, and the currency became almost worthless. Print without limit, and money loses all its value. So if printing money causes inflation, shouldn't the goal be zero inflation? Surprisingly, no. Central banks aim for a little, usually around 2% a year. Why deliberately let your money lose value? Because the opposite, deflation, falling prices, is worse. If you knew everything would be cheaper next month, you'd wait to buy. So would everyone. Spending freezes, businesses shrink, people lose jobs, and the economy seizes up. Japan got stuck in exactly this for years. It's lost decades. A little inflation keeps money moving. So what does this mean for you and that $100 bill sitting in the drawer? Cash quietly loses a little value every year, by design. Money left untouched isn't standing still. It's slowly sliding backwards. But at least now it isn't a mystery. Inflation isn't magic, and it isn't just prices going up. It's a balance between how much money exists and how much real stuff there is, pushed by demand, by rising costs, and by what people expect, and steered imperfectly by a hand on a single dial. So the next time you hear that prices are going up, you won't just nod along. You'll know which force is doing it and why. You'll understand what's really happening to the money in your pocket. And that $100 bill in the drawer, it'll never quite look the same again.